Hi, everybody. Welcome to another episode of Stock Talk. My name is Aman. I'm an investment coach here at Sage Investors, and this is episode 33. Today, I really want to talk a little bit about ETFs. And right now, ETFs are really the big investment vehicle of choice right now. We've seen such a huge outflow of money going out of traditional mutual fund, actively managed kind of portfolios into ETFs. And the great thing about ETFs is that the way they've been marketed as very simple, low cost, instant exposure, trades on the stock market, so you get a better price discovery. That's how they've been marketed, and they've been the group of people that are, or institutions that have taken the lead and pounded the table on these concepts have been led by companies like Vanguard, and led by their founder and chairman Jack Bogle, who have espoused the concepts of passive investing as the appropriate way for most of us to meet our financial goals. Passively investing, just investing and using cheap, low-cost ETFs that invest in broad indexes like an S&P 500, a TSX Composite. That's been the pounding of the table of passive investment. And the research is out there that shows that actively managed portfolios, only like 75% of portfolios can't even earn the market rate of return. And enough research showing that if you actually looked at actively managed portfolio managers, maybe 1 out of 100 could actually outperform the market consistently on a regular basis over a long period of time. So the evidence is out there that passive investment is the way to go. So it's interesting that I pick up the newspaper yesterday in the Globe and Mail, and I see this kind of news release or this article saying Vanguard launches 4 actively managed ETFs. And I'm going, whoa, wait a minute. This is the company that's pounding the table and espoused to the values of passive investing. They're selling actively managed ETFs. They're selling ETFs that they've basically poo-pooed and said, this stuff, you shouldn't even be considering that. So I looked at it and said they introduced 4 new funds that they're on the market. Go out and buy them right now if you want to. They have the Vanguard Global Minimum Volatility ETF. You can buy the Global Value Factor ETF. You can buy a Global Minimum Factor ETF. You can buy a Global Liquidity Factor ETF. These to me sound like very much like, and I talked about this a few episodes ago, about investing flavors of the month, investing themes that are, the it kind of strategies. And here we go, low volatility, factor type investing. This is what's out there. The big thing they're talking about is the management fees are 0.35%, which are low. That's fine. But at the end of the day, you're talking about actively managed portfolios have a hard time earning a market rate of return. And so, if they're having a hard time earning a market rate of return, the 0.35% doesn't really mean much. So I'm confused. So here we have, companies. But to me, this is a very telling moment we're at. And to me, it reminds me very much so of what life was like in the early 90s, mid-90s, when mutual funds were all the rage, just like the way ETFs were the rage right now. And you had a lot of people, and they were marketed essentially in the same fashion, low cost, cheap, instant diversification. And that's how they were marketed. But then over time, you saw kind of a switch and sort of a more prevalence of different actively managed portfolios and more specialized niche kind of portfolios, niche kind of funds. And to me, it seems like we're seeing the same thing. So why is that happening? Well, the fact of the matter is, if your passively managed portfolios are cheap, that means either your margins are really low or you're not getting enough volume if people are buying it. Well, it seems like a lot of people are putting money into ETFs. So it's got to be a cost thing or a margin thing. So you really don't make much when you're charging 0.02 or 0.2 basis points. You got to get some more margin somewhere. And so what we're seeing now, I think, is we're seeing a shakedown. We're seeing a lot of these ETF companies are starting to differentiate themselves. Like up until now, they've all offered same passive, low-cost portfolios. But now they're trying to shake it up and try to make a little bit of differentiation. So they're throwing all kinds of products out there and trying to kind of see what sticks. And so right now they're throwing a lot of low volatility kind of portfolios. We're talking about factor, timing kind of portfolios, value, growth, momentum. These are the same portfolios that mutual funds offered, but they were charging 3 or 4%, but now they're charging maybe 0.35 to 1%. So what's going on? And so the other factor what I think we're starting to see is now the companies are trying to have got a critical mass of people now investing in their products. So what they're trying to do now, and this is happening with the robo-advisors too, is that they're now starting that process of basically upselling everybody to other products. So it's like, we know you're managing, you've got, you're an S&P 500 and a NASDAQ and a global ETF and an emerging markets ETF. That's great. But you might want to maybe think about putting a little bit of money into socially responsible ETFs. Or you know what, the millennials are coming and they're going to dominate the world. So you may want to put a little bit of money. You want to take a little chunk out of your core portfolio and put a little bit into this millennial portfolio that we've developed. Or you might want to just pick up, obesity. People are getting fat all over the place. So maybe you want to just put some money into companies that are figuring out how to take away people who lose obesity. There's an ETF for that. So I think right now, so I really got wired when I saw this thing, when I saw, when I'm seeing these companies that are now, who are all espousing passively managed philosophies, now adopting and selling actively managed portfolios. It really, the moral here, what I want to share with you is that you really need to, when you're looking at ETFs, just don't assume and take the marketing that tells you, oh, it's simple, low cost, and all that. You really need to open up the hood and see what these things are investing in. And it's almost just, I'm sorry to say this, it's like investing in stocks, individual stocks. You analyze companies, balance sheets, income statements. Well, ETFs, you're going to have to analyze the same thing, probably more from a statistical perspective and a macroeconomic perspective, which could be harder than investing in Starbucks. I know what Starbucks is doing. So very important that you open up the hood and see what kind of philosophy and what kind of concentration of assets that the ETFs are putting their money into, because it's important, because the lines, I think, are going to get a lot more blurred, and for the average person out there who just doesn't know any better, they may get put into things that they really have no business being put into. So it's really, I really feel strongly about it, and it's just something I wanted to share with you guys. So that's all I got for you today, and if you have any questions about this or anything else, investing related, I'd be more than happy to answer it. You can hit me through email, through my website, www.sageinvestors.ca, or you can hit me through Twitter. I'm on there tweeting on all kinds of observations of the markets and everything. My handle is @SageInvestors. So that's another edition of Stock Talk. My name is Aman of Sage Investors, and we'll catch you again another time. Take care.